First of all, I don't know everything. And I don't know daily price movements. I don't know weekly price movements. I don't even really know monthly price movements. All I know for sure is that gold is money. The dollar is a money substitute, and money substitutes are inflated up the wazoo, and they are in the process of dying. And we can see that. So how I keep sane is I make sure I have a level of cash. And no, I'm not a fan of fiat cash or dollars or anything, but I understand that. And I've been through this several times already. I've been a gold bug and a gold analyst since I discovered Ron Paul in 2011, 2012. So it's taken me almost 10 years to come to terms with these emotional realities. But in order to keep your sanity, especially in times like these, when gold goes down, in times when we would expect it to just skyrocket up, you need cash. You need to have that emotional stability to tell yourself that when it goes down in times when it doesn't make sense to you or anybody with any modicum of knowledge of the monetary system for real, that you need to be able to buy the dip. Because if you can't do that, you'll be thrown out of the game, especially if you're on leverage. But making sure that if we go into another liquidity crisis, which we've seen in 2008, we've seen it in 2020, we even saw it in 2000, with the dot-com crash, which took 2 years to play out. And every time it happens, it happens more extreme and quicker and in less time. So the question is there going to be another liquidity crisis? My answer is yes. But at some point, the liquidity crisis is going to lead to rising gold, which it did in the late 1970s instead of falling gold. The question that we're all asking ourselves is the next liquidity crisis going to lead to a 2020 type crash or a 1978 to 1980 type explosion? And anyone who says that they can answer that question for sure and they know the answer is fooling themselves, because we don't know. We need that cash to be able to buy the dip in case there's another temporary deflationary liquidity crisis, which I'm pretty sure will be even more extreme and take less time than it did in 2020, which was about 2 weeks. It might be a week, even in a day or two. It's not going to take long, but you've got to have the cash to be ready for it. If you were trading in the 1970s, or you look into that history, Nixon went off the gold standard finally in the last phase of it was 1973. But from 1971 to 1973, Nixon tried to put it back, tried to put gold back on a set dollar exchange rate. And then we had the 1974 to 1976 bear market in gold. And you can look back at that time and you can look at how gold was performing in commodity terms, and it was just as bad as it is now. And it ended in 1976, I think August 23rd, 1976. From that point, gold really started outperforming commodities. And from 1976 to 1980, we all know what happened. Gold went up about an order of magnitude, and that's what we're all waiting for. We're waiting for the world to give up on the dollar, or at least to understand where we're in the mid-1970s, which made no sense. Why should gold fall from 1974 to 1976? It doesn't make any sense, but it did happen. So the fact that it's happening now, yeah, it doesn't make sense fundamentally, but markets don't always go by fundamentals. That's just something you have to accept. So we have to understand that fundamentals do not always push markets alone. And we're in one of those times, like in the mid-1970s. But the other thing we have to realize, and we have to internalize and understand as traders, is that this is going to end. This correction is going to end. And in order to get through it, you need to have the cash to have that mental stability, because we are all human beings and we're all affected by our emotions. And instead of denying them, we have to embrace them and understand them and figure out a way to stay rational in the face of them. Okay, so with the definition of hyperinflation. Now, I'm not trying to be a prophet here or telling you exactly when it's going to happen, but here's the point. The point is that hyperinflation in, let's say, popular economic terms is when consumer prices rise by a certain percentage in a certain given period of time, let's say 50% in a month or whatever. There's two problems with that. First of all, how do you measure what consumer prices are? Because everybody buys different things. I mean, if you have a garden in your backyard, you don't have to buy food, and you have chickens and you have eggs or you have cows or whatever, you don't have to buy meat. So what's your inflation rate? It might be very, very low. Maybe you have to buy electricity for your barn or whatever it is. It's not going to be that much. The second one is the arbitrariness of it. Why 50%? Why not 52.7%? Why not 63.8%? I mean, all these numbers are made up by who? Experts? How much do we trust experts? We can go back a year and a half and, try to figure out how much we trust experts in various contexts. It's not that much. So these definitions of hyperinflation are not scientific. So what is hyperinflation when it hits? What is it that is happening to people? When hyperinflation really hits, what is happening is that people do not want to hold money as a monetary reserve anymore. As hyperinflation gets faster and faster and faster, you have people trying to spend more and more of it faster and faster without holding any of it for any amount of time. The objective definition of a hyperinflation would not be a certain price increase over a certain period of time. It would be the point where the average consumer's desire to hold cash balances as a monetary reserve falls to zero, and they don't want to hold money as savings or as a rainy day fund for any amount of time at all. They just, whatever they make, they want to spend immediately on whatever that they can buy. Have we hit that point yet? No, we haven't hit that point yet, but we have hit a point where people are attacking the commodity markets and trying to buy as much as they can, as fast as they can, because they fear certain things and they'd rather have the commodities than the money. The monetary reserve is losing value too quickly. That's exactly what's happening. And if inflation expectations 6 months to a year out are higher than inflation expectations 5-6 years out, then it's saying that people want to get rid of money faster. That's backwardation in the inflation or rising prices market itself. And that's what is happening. We're seeing short-term inflation expectations higher than long-term inflation expectations. Imagine someone who's actually in, a Weimar economy, and you say, what's your inflation expectation 4 or 5 years out? What's he going to say? Like, who cares? Like, I need to get rid of the money now. Like, my inflation expectations for like a month out is 100%. Well, what are you asking me for? Who cares about 4 years? We're not there yet, but that's definitely the direction we're heading. Look, it's very difficult being a gold bug now, and it was difficult in March 2020, and it was difficult in 2008, and it was difficult from 1980 to 2000. There are times when it's difficult, but if you understand what money is, and it's the connection of every part of the market to every other part of the market, and that the way that this gold is being distributed now, which is through dollars primarily, which is a gold substitute, still a gold substitute, that system is being poisoned. If you just keep that in your head and understand the reality of what the monetary system is, you can get through this as long as you're not leveraged and you're not gambling, and you've got a steady income and you know what's coming. You can get through it, and we're going to get through it, along with the rest of the insanity in the world. And I'm sure you imply or figure out what I'm talking about. It's all connected. Everything is connected, and we will get out of this in one piece, one way or another. And I wish you all the best.